My name is Deepesh Patel, editor at Trade Finance Global and host of the podcast Trade Finance Talks. We currently live in incredibly uncertain times geopolitically and from a macroeconomic perspective. Today I'm delighted to be joined by Rod Hutchinson at Veridapt and Peter Hopkins at DrumRisk. Welcome to London and welcome to Trade Finance Talks. So, quick introduction, elevator pitch in no more than 30 seconds or so. Who are you, where are you from, and what do you do? Rod, over to you.
Sure. Yeah, again, thank you, Deepesh, for having us today. So yes, Rod Hutchinson. I joined Veridapt just under a year ago. Prior to that, I had 20 plus years on the banking side in commodity finance. Now with Veridapt, which is really a risk management solution provider in terms of real-time monitoring with some other features for the commodity finance world.
Peter.
Good afternoon and thanks for inviting me. Drum's been around for 25 years. We were one of the original companies to develop the CMA. DrumRisk still is predominantly active in the collateral management market. We've seen cycles of where that's come up and gone down. And then there's also now Drum Advisory, which is involved with the borrowing base audit side, where again we have brought in the physical into the normal inventory and financial.
Rod, what are some of the longer term trends that you're seeing with regards to the logistics and the supply chain space, particularly with regards to supply chain management, but also access to liquidity?
Sure. In terms of challenges in the supply chain and longer term effects on liquidity, we've seen a lot of financiers de-risking, getting out of the market when there's really been an increased need for liquidity. That's partly price driven, but also supply chain driven in terms of bottlenecks in the supply chain. Also this movement from just in time to just in case, which is meaning companies are holding more inventory on their balance sheet, needing more working capital. So there's a real need in the market for liquidity, whilst you've also got uncertain times for financiers in terms of providing additional liquidity.
Okay, thank you. Let's talk a little bit more about the risks, because I guess being able to monitor the physical movement of goods around the supply chain from A to B is pretty critical, especially when you're then talking about the provision of liquidity, trade, supply chain finance, etc. Rod, can you talk a bit more about what risks you need to think of when it comes to monitoring the physical flow of goods in the supply chain?
Sure. So I think part of that, we have bigger numbers now, inflated commodity prices. So really have to think about that in the context of financing, liquidity needs, but also we haven't talked about yet the risks in theft and fraud. And that has been something that has been in the industry unfortunately for many years, and I believe there are technologies and companies that can provide a better solutions.
Well, if you're looking at the risks and we look at the frauds and we look at what has happened, we only really need to go for 2020. 2020 changed everything, but then 2020 wasn't new. We've seen it all time and time again. Now, if you're looking at what is the risk is fraud, and the risk is the non-effectiveness of the CMA and no technical support as well.
What's going wrong?
If we go back 25 years, we would have been mandated by the big trade companies. We were predominantly used by them, and they would pay for the service. And that therefore meant that the rules were clear. Everybody knew what they were getting. There was a very tight monitoring of the service and what was provided and what could be expected. Where we are now is that we are working for the international banks and the lenders and the financiers, but it's the borrower who pays. And where we found ourselves over the last 15 years is that there is a race to the bottom. And unfortunately that has now come home to roost, and we have, as I just mentioned, with Singapore and everything else, if you don't have the CMA in some way quality controlled and regulated, and there being a professional service there, whether it's Drum or another, and where we then also bring in and work in conjunction with Veridapt and the technical expertise, we're going to be seeing more and more of these events happen.
Also, just to follow on from Peter, Veridapt provides real-time monitoring of inventories, and I think that is a gap sometimes within the CMA world. Just practically speaking, being able to provide that sort of information, that sort of physical to digital, real time.
Would you say that the combination of what typically a CMA would do, but then the additional technology to lower the risk, are you saying that is in turn going to give some cause for comfort from a lender perspective, reduced risk, and therefore perhaps the provision of more trade finance, or even trade finance at a cheaper price because lower risk?
Absolutely spot on, and that's where we come from.
And Peter, from a storage and inspection process, what are the pieces of information that humans are really critical for, and what are the processes? Are there processes that you believe technology can really help to alleviate and reduce some of the risks?
The human being is there to prevent the unplanned, unforeseen, and also the corrupt. Our key elements, or our key purpose, is to actually physically be there to physically control certain choke points, critical control points as we call them, where then ultimately we give a declaration which then the lender can use and be absolutely certain that is what is there. If we're looking at tank farms, or we're looking at certain commodities where Veridapt can be inserted as well, it's a brilliant checks and balances on our personnel, and it's therefore double reporting to a lender, so that they actually have double the information, and you're cross-referencing everything all the time.
Can you give any examples or case studies of how that works in real time, in real life?
Just looking at a liquids example, so could be crude, could be refined product, in tank. CMA could be used or couldn't be used in this example, but what our technology does, it really is some hardware, very non-intrusive hardware that goes in, pulls from the sensors at a terminal that information and feeds it up to, I'll just use a bank for an example, so the bank again can see a real-time feed of tank levels, ingestions, etc., outflows within those tanks.
It could then feed directly into whether it's the daily report or the twice weekly or the weekly report as submitted by the collateral manager. You've then actually got the technical data backing up then dip tests and whatever. That's where it then really works well.
Is there a hypothetical case study that Veridapt and DrumRisk could work on? How could that actually work in reality, Rod?
I think we can talk to one example in the alumina space.
So you have alumina, obviously in granular form. We have, it comes in bulk. So we have the classic critical control points, i.e. discharge, weigh bridges, into storage, everything else. Uniform segregated storage, if there is third-party goods there. And then it goes through to processing, and then out on the other side we then have the billet, bar, and whichever other form it takes place. So that sits within a whole CMA, and we will obviously have the controls throughout. Where in the future, and what we're working on, where it completely takes it to a different level, is if we then have Veridapt inserted in at the alumina element, or the alumina side of it, because then there is, as I mentioned earlier on, a double verification of everything, all the information flow back to the lender. It's tight.
So just with Veridapt's role in this particular transaction is it's all around stockpile monitoring. So it's different from monitoring collateral, say liquids in tank. It's a different type of technology. It's around LiDAR, laser technology, building a formation that we can calculate the mass. And so that information, when we've got stockpiles of alumina, we can push that up to the financier, obviously together with a CMA, and again having real-time, real independent information from, really the physical to the digital.
But why aren't financiers doing this anyway? Because you would imagine that they have the excellent inspection companies, but they also have the additional technology because it's bringing them peace of mind, right?
Without being cynical, there's an awful lot of effort, an awful lot of time being spent on the blockchain. We've been here and we've discussed this one before. The blockchain is, yes, pretty well now a very tight financial documentation flow. But unfortunately at the moment, neither does it speak to the physical in real time or the physical speak to the blockchain in real time, so that you close the two together. So we have still these two completely different streams, and at the moment the operational is just not being mirrored into the blockchain developments. Hopefully, let's see how this develops, but certainly if the CMA and Veridapt can link in, then we actually join the two together, and that would be a very major step forward.
I think it would be a huge win for the industry if you collaborate in that way.
Rod, what exactly are lenders spending their money on at the moment when it comes to new technologies in the trade and supply chain space? Which areas are they actually buying into?
Look, I think the whole digitization process is something very interesting for banks and other players within the commodity finance space. So, with blockchain or without, we see a pretty good adoption there, and it seems to be accelerating. Just to switch a bit to our world, and what I've experienced is, the adoption takes a long time, and I think that also with the digitization, it's a very long cycle. The financiers have to go through approval processes. There's obviously other technology that financiers need to think about. I guess the point is it's a very long cycle.
Are there additional benefits? So say from an insurance covers perspective, especially if you can respond quickly in real time, etc.
Sure, insurance is very important, but just to quickly add to what Peter is saying, that there's also this reconciliation piece to it, that there is software available to really reconcile for financiers out there what's gone in, what's gone out, what the levels currently are, which the industry is just not there yet in terms of those advancements. But to your question on the insurance, absolutely, we've seen with some of the banks we're working with in terms of getting insurance cover, it's helped with premiums. Definitely it can speed up the time it takes to being working towards a recovery, or even just being at the table to talk it through to see what's happening.
Yeah, no, thank you, Rod. And I guess with everyone's priorities being right now on ESG, sustainable supply chains, I imagine that this added verification is extremely good for lenders and even for consumers of products, perhaps, because they can finally track their entire supply chain from farm to fork, whatever it is, right?
Sure. I mean, look, that's a very large topic. Obviously ESG, and if we just focus on the E for this conversation, absolutely there's technology to track and help calculate your footprint. Certainly in our respect, at Veridapt, we have that technology available. We're able to push it up to the customer and really very accurately track their carbon footprint.
So what's next for the industry?
Risk management, continually, I think, improves. Again, financiers getting better, more experience, etc. But I think technology has a real role to play there. The key there is really adoption, and I guess the challenges with adoption, how to meet that is collaboration. And there's not one size fits all. There's a lot of technology out there. So again, I think there's definitely a role for the technology providers to collaborate and bring solutions to the market.
Peter, is collaboration and the answer? Because I guess a lot of what's going on in the market, the macroeconomic, the geopolitical, is quite far out of our control. Is collaboration the way forward and the way we're going to kind of be able to ride the turmoil and the uncertainty?
Yeah, I hope so. Yes. The markets are all over the place. The lenders, they need to have some. You can't use the word guarantee, but they need some sort of comfort. They need to be assured. Whether it's the CMA and what that is needs to be more heavily controlled and tightened up. But then particular, then slotting in, the technical, to give it a far more, a complete service, which again, as has been mentioned, when it comes to the insurance market and everything else, and actually guaranteeing that at this point, this was received, this was held. That's the essential thing. That is the way forward.
Brilliant. Well, I think really when we think about bridging the financial and the physical supply chain, really rethinking the way we deal with risk from a lender, from a borrower perspective is incredibly critical. And I think the key take home from this is actually looking at applying technologies to existing processes, creating new processes are really going to help bridge that gap. But I also think with the huge advent of lots of different technologies operating in different silos, all solving individual problems, I think the key really is also education, and educating the market about who does what for who,
right,
and who's kind of benefiting of this. So on that note, Peter and Rod, thank you very much for joining us here in London on Trade Finance Talks. It's been such a pleasure having you.
Thank you.
Thanks, Deepesh.